There we go. I got my microphone on now. So should be good there. I wanted to show you guys a couple different things though. So the student managed fund policy, because I don't know, I think from last year some of you saw it, but we haven't talked about it much this year, so for this semester. So just so you kind of see what's going on, it's mostly just like, hey, we want people to be able to learn about investing, and then kind of how it's set up and everything. But in here we have students can join during the first 4 weeks of the semester, and then you have to be like attending meetings to be able to vote. That's just so somebody doesn't randomly show up and just start voting on stuff like and never come back. And then I'll keep track of attendance and stuff once we get going here. And then that's all just like boilerplate. And then we'll have different industry groups set up, which we've already done over the last couple meetings. And let me see where it says. I'll take care of the fund during the breaks, fees. They don't charge us fees, all that kind of stuff. We'll have a policy in place, and then they want us to report at the university board meets in October. So we're going to meet with them and report on our performance. But we don't have any performance for right now. So hey, so we might not be meeting in this October. I'm not sure what they want us to do for this October, but definitely 1 year from now, we'll be meeting with them. I'll figure out, I have a meeting with the vice president to figure out what all that is going to look like. So our allocations is 100%, kind of 100% US medium and large cap blend. They have actually talked about getting rid of that, saying we don't have to have that. It could be any stocks. So for right now, like US stocks, and then they can be smaller. They don't necessarily have to be the same size as the S&P 500. And then we'll go through asset management group with our people. And then so the university has their own investment policy, so we have to follow all this stuff. The only rules that are like not normal is that we can't invest in like fossil fuel polluting companies, and then we can't invest in stuff that like antithetical to the educational environment. So marijuana stocks and tobacco stocks is what that usually means. And then somewhere on here, it lists how we determine what a fossil fuel producing company is. But there's a group called, they call 350.org, something like that. They're in here somewhere. I forget. I don't know where they are. Where it says. But it says somewhere on here how to determine that. But I wanted you to be able to see this so we can review it if you want. If you have any questions about it or anything, I can point out any parts of it that you want to see. But it's just like, here's all the different types of things that we might invest in. This is for the universities. They're the big investment manager for the whole university's portfolio. So we don't have to follow this exactly, right? But that's just the kind of things that they would use. So any questions about that? Oh, there's a 350.org thing. So we are not allowed to invest in the top 200 public coal, oil, or gas companies as defined by 350.org. As of right now, you have to pay to get their list. So I looked it up and I found the 2016 list published online somewhere, but the current list is you have to pay for it. So I'm going to ask the university if they pay for it. I'm not going to pay for it. Yeah. Okay. Any questions about that? This is what the market. This is actually I switched from S&P to all, so I don't actually know what all includes. All stocks listed on any U.S. stock exchanges. Okay, so there you go. So this is what the market looks like. There's a couple green blips just randomly thrown about there. So Tom Sovereign Holding Corp seems to be doing good. Don't know who that is. And LI Auto and Domino's Pizza. Okay, I know them. But mostly everybody's down today. And that's because the Federal Reserve raised interest rates, right? So they announced on Wednesday of this past week that they're going to up interest rates. Their target, they set a target rate, like a range. So I'm going to go back over here and we're going to look at it real quick. So the United States has an effective rate right now at 3.08, and their target rate is 3.25. Oops, no, that's okay. The target rate is 3.25. This is just a graph of what it's been. So this was this week. This is one spike right here. So they raised interest rates, and that usually just means that companies are going to have to pay more to finance, right? And I think we talked about this last time. If I were to look at, I would work it. I happen to have something picked. I have an index. I'll do that. Let's pick it. So I was gonna look at Duke Energy. So do that real quick, and then I'll look at their WACC, their weighted average cost of capital. And so this company is a little more like even than say like Apple, which would be just all blue, because they are just equity is 100% of their stuff. But for this company, Duke is a little more mixed, right? And so to finance a company, they have to either sell stock or borrow, and the cost of borrowing is going to go up pretty dramatically. So that's what's happening here. So currently for Duke Energy, that's the company that I just happen to pull up right now, their cost of debt is 5% on average. And this, they might have some debt that's more than 5%, some debt that's less than 5%, but on average, they cost about 5% to borrow money. That's going to go up, especially if we look at this chart is DDIS. DDIS is their debt distribution. We go look and we say, okay, well, what kinds of debts they have that are variable? We have floating and variable debts, and they have long-term debts that are variable. So those are probably going to go up a lot. But that's actually perpetual. So this isn't super far in the future. This is like a recurring debt that they pay off and borrow back and pay off and borrow back over and over again. But this is 2052, so they got a 2052 debt on a variable rate. So right now it says 3.25, but since it's variable, it could change. It is callable though. So if it gets too high, they can pay it off and then issue a new debt at a different rate. But if the interest rates are getting too high, it's not going to make sense for them to try to issue a new debt because the interest rate's high. So they'll issue a new debt, it'll still be a high rate, right? So that's why the market's tanking, is because what happened to my because the Federal Reserve increased their target rate. So this is kind of like a future track of what was going on. But if we go back a little bit, the implied rate. So this is going forward in the future. I want to look back, see if I can go back like a couple of years. See if it'll do it. There you go. So implied rate of 1.89, and then it went down. And then this is COVID time. So the Fed lowered rates for COVID. You actually see this graph is like negative now. And that's going from 19 to 20, like rates keep going down. And then can I make this, I'll maximize this graph and see if I can pull it forward. Oop. Really? Okay, I was kind of hoping they'd put more than like this, but that's okay. So we go forward a couple of years, say, okay, mid COVID. Still not good enough because they didn't start raising rates yet. So we go forward like a few more months. I want to see when they switch it. There we go. So then they start switching it. So they're lowering rates and they're like, okay, let's start raising them. They're still like really low. So raising them still is a negative bar graph here, but then they start coming up. And then as they keep going up until like close to now, you're going to start seeing them go up again. So that was the target rate then. And then we go today is 2021. And then today their target rate is going to be between 3 and 3.5. So it puts it at, it just give you a number of 3.25, but they're ranging between 3 and 3.5. And the effective rate is 3.08. Other countries are totally different. Like Japan has a negative rate, right? And then the Eurozone has really low rates compared to us. England is about just slightly less than us, and then India is super high compared to us. So it's all it's all different everywhere, but we're gonna keep that in mind for when we're looking at companies. What companies have to borrow a lot, or what companies are more susceptible to interest rate increases? And we're very likely to be in a recession, right? So for the next so the Fed, when they announced the interest rate increase, they said that they're going to keep increasing rates. They're going to cap out a little over 4% in 2024. And so that's what we can expect over the next 2 years. The rates will keep going up, market's going to keep going down. That's kind of the thought process there. What do you guys think about that? Yeah, I struggle with that. I got there we go. So that's a good question. So I'm going to repeat it for the sake of the recording. Is Matt asked what do we think about an inverse ETF on the S&P 500? And my struggle is that we're supposed to be benchmarking the S&P 500, and so like if our main position is opposite of what we're targeting, it looks kind of shady, I guess. I don't know. I'm not like, I don't hate it. I don't hate it because like when your stance is, I think the market's gonna suck, then maybe your position should be, I want the opposite of suck, right? So like that's okay. I don't have a good answer. It's just, you know, from like a asset manager job, if like let's say you're the asset manager for the university, and I mean that's kind of what we're doing, and we say, listen, we really think marijuana stocks are going to do good. They say, well, yeah, but you're not doing that. It doesn't mesh with what we're doing. Um, you know, that part is hard. So we're not prohibited from getting an inverse ETF. That's not against the rules. But then what happens with an inverse ETF is the rest of the world is fighting to they want the market to go up. Everybody wants the market to go up. So if you bet against it, you're like betting against everybody, saying the whole world's wrong. Sometimes the whole world is wrong. I was going to show you this. Oh, I don't know what it's doing here. SPX US index. I don't know why it's not. That's super weird. Okay. There we go. Okay, so this is the like the stock market. This is S&P 500. It's just a representation of the S&P 500, but it's been going down the whole year. Year to date, it's been going down. I want to show you a couple things you can do on here too. So if you're using the Bloomberg terminal, there's annotation available. So there's a little button right here at the top center that says annotate. You click on that. It gives you like you can draw on here. It's not. I don't think it's as good as like Trading View. Like Trading View is really good for annotating on graphs and stuff. But I didn't want to do that. But it's still decent. And I kind of wanted to show a couple things. Let me like zoom out and move. I want to show you this. I just thought this was super interesting. If you look at like what was going on in 2012 to 2015, I'm going to draw just like a line on here. And I'm going to pick like random points. Not really random points because I plotted this out ahead of time. But I'm going to draw like this. What about here? Yeah, I think maybe like right there. So I'm just drawing a line. So all it is like I picked 2 points, and it's like the tops of these 2 lines. And then I'm going to scroll back, and it happens to hit these points too that were like way years later. And it's just super interesting that the market like comes down, and then rallies and hits that exact line. Like if you trace the top of this, you know, these little tops back here, back to this line, and then almost about that line, then almost about there, and then eventually it breaks through because that just happened. But then we broke through again, and we kind of rallied back to that line, and then we're back down again. So we're below this kind of trend line or whatever, support resistance line. And so, you know, that doesn't really mean much by itself, but it's kind of interesting that it like happens to, the market happens to come back to that years later. We kind of go back and look, right? So you just like things going on here affect things in the future. So we're down below that now, and we're probably going to keep crashing. So this is not really a good trend line, but I mean, that's kind of the way we're going now, these tops, right? So the definition of a bear market is like lower highs and lower lows, right? And that's kind of what's happening. So each of these highs is lower than the previous one. And that's where we're in this trend here. We're going to end up, I mean, we also have like, this is just a horizontal line, but like these are kind of close to each other. These 2 horizontal lines were about at the point where we were in June, right? So like there's that area, and there's like potentially this area, right? So anywhere in here we might end up, and that's not looking too good, right? So if the market ends up going down and going somewhere in this range, in this kind of like triangle shape in the market somewhere in there, that's pretty low, right? Like from where it is now to down here is about a 30% drop, right? 35, about 35, 36% drop from where it is now to where it was back then, 2020. The market very easily could do that, and 30% drop is pretty awful. So now if we were at an inverse ETF fund, then we'd have a 30% gain, right? Like, okay, cool. And we can get pretty risky with that. Like we're not allowed to have leverage in the sense that we can't have a margin account, but there's inverse ETFs with leverage built into them, right? So you can have a levered ETF. Do we want to have ETFs, or do we want to look at individual stocks? That's the hard thing to decide on. So the way that I might approach it is I would look at like a top-down analysis, and I'd say, okay, well, what's going on in the world, and like, what major macro factors are going to affect the market, and then what companies react to those macro factors favorably. And so, I mean, like waste management tends to do great in a recession because people are going to have garbage anyway, right? You can't say, well, I'm just going to stop throwing things away now. Like that doesn't really work. Some people say that, but that still doesn't work for them. They make TV shows about them. So, you might say, let me go back here. So like waste management, I don't know that we should buy waste management or not, but I'm just going to show them. So over the last year, they've been okay, right? Because like they're not really, over the last 5 years, they've been doing great. They're not really like affected by by a recession as much as somebody else might be. I'm going to compare them to like just the S&P 500. I'm going to do a really thin line will be the S&P, and I'll make it like red. So red will be the S&P, and blue is waste management. So you can see over the last year, this is just over the last 1 year, but let's go after the last 2 years or something. The waste management is doing better than the S&P over the last couple of years, right? Some now in this range from November of 2020 to about September of 2021, they were kind of in line with each other, but throughout that time, S&P was performing a little better. So that's because when the whole market's going up, so waste management goes with it. Then the whole market goes down, waste management doesn't get pulled down. It might get pulled up because everyone's going up, but it doesn't get pulled down when everyone's going down. So those kinds of companies where they're kind of counter-cyclical a little bit might be good, or they're just defensive in general be good. And then when you look at this, I mean, today's not very good, but let's go. Let me. I don't think I can escape. How do I get out of it? There it goes. And instead of 1 day performance, let's do like 6-month performance, and then look at it and say, okay, so now it's not like if you just look at 1 day, everybody's red. But if you go look, this is over the last 6 months. What are some of the greener sections? It's going to be down here in utilities. So it's hard for me to like point it with my mouse without it like opening up a window. But in the bottom right-hand corner is utilities, right? And so those all seem to be I mean, not whoever the heck this is, National Grid, they suck, but everybody else looks pretty good in there, right? And then over here in energy, kind of a mixed bag. And that's really because of energy as a sector is like any companies that have to do with energy. And some of them are energy producers, and some of them are energy suppliers, and some of them are importers and exporters and all kinds of stuff. And so it's a mixed bag there because energy costs have been going up a ton. But if I'm a producer of energy, then sweet, right? But if I'm somebody who has to like who I'm, I don't know, selling or importing or exporting energy, then maybe the shipping costs outweigh the profits that's available there, right? So generally real estate's going to be tanking. So we could try to find an inverse real estate, because we know for sure real estate's going to get hammered with increasing interest rates, right? Nobody wants to buy a house right now. But once we hit the bottom of the real estate market and interest rates start coming back down again, real estate is probably going to boom. So then that's when we want to switch. So I'm down to try to find some kind of inverse real estate ETF if you want to do that route. Otherwise, we do individual stocks and we say, what's going to be defensive here. Healthcare tends to be kind of independent of the overall economy, and it really depends on what's going on. Because if it's like a biotech company and they're developing a new drug, it doesn't matter if there's a recession or not. The new drug, if it's going to make them billions of dollars, right? Because it's like some cancer cure. Doesn't matter if we're in we can be in the Great Depression. If somebody cures cancer, well, they're going to make a lot of money, right? So, and then what else? I don't know. Like that's just kind of my thoughts. Just consumer defensive probably be good too, because those are the things. So these are generally consumer defensive is like the stuff you would buy at a store where you would probably buy that no matter what's going on with the economy, right? So Walmart is the big player there because you're in Procter and Gamble, right? You're going to buy cleaning supplies for your house even if we're in a recession. You're probably going to shop at Walmart regardless, right? Or in Costco. And then over here, like General Mills, cereal's fine in a recession, right? Monster energy drinks, gamers don't care about that, I guess. And then cigarettes, right? We can't buy those, so we're out of that. But and then Mondelez is the company that makes Oreos, right? Yeah. Anyway, what do you all think? What are some thoughts? Absolutely. Not directly. We can do an ETF. So to trade commodities, you'd have to trade futures contracts, like directly if you want to trade commodities directly, and we can't do that. But we could buy an ETF that represents the commodity. So GLD is the gold ETF, right? If we wanted to own gold, we could buy GLD. We can't go buy a futures contract on the spot price of gold. requires leverage. That's the reason why, and we require a lot more capital. I I used to trade commodities, and I don't know what the minimum amount to open an account is, but it's not 25. Well, it could be 25,000, but I wouldn't do it. Right? Like 100,000 probably makes sense. So good question. For the Zoom, the question was, can we buy commodities? Okay, so did anybody want to look at one? I did a couple other things I want to pull up first before we do that. So some tools that you can use for your research. So the Excel template library, which we looked at last time, but it's XLTP is the function. When you're in Bloomberg, you're just in the searching to do XLTP. And I like the DCF model, right? So since I know it, I'm just XDCF would be the discounted cash flow model. And if I hit enter, it'll pull that up, but I'm not going to do that because I want to show you all of them and not just that one. So if you run XLTP and you're like, I don't know which specific XLTP I want to run, just type XLTP and hit enter, and it'll pull up this, which is just kind of like this is like the home screen overview. Here's a bunch of things you could download. I don't want that. I want to hit list view, and that'll give me literally every Excel file I could download from Bloomberg. And most of these I don't necessarily want, right? The Taiwan fund comparison, okay, I'm sure somebody likes that, but not me. Historical vessel tracker, that sounds kind of interesting, but not helpful for us. So I'm going to go to the top. I starred a few that I think are somewhat useful. The star only applies to me. When you log in, you won't see my stars because it's just my account, but I starred them so I can pull them up and show you. So in-depth analysis, financial analysis, these are very similar to each other. One of them is like, just goes a little bit deeper. The other one is specifically on their 3 financial statements. In-depth fundamentals, which is more financial statements. Comparable valuation, which we can do in the terminal. We don't necessarily have to download Excel for it, but that would be to look at competitors. And then snapshot with financials. And then there's a few others, but if you go in here and type DCF or discounted cash flow and then hit enter, that's the one right here. And if you double click on it, it'll download. All of the computers in the Bloomberg lab have Bloomberg Excel like connected. So on Excel, if you open it, Bloomberg is one of the choices here. If you're on your own home version or you go to the library or something like that, Bloomberg won't be an option. It's not installed everywhere. It's only installed in this classroom. But you can use the Bloomberg function. So if you go over, let me pick a number here, find one that works. None of these work. Okay, so there we go. So Bloomberg has its own series of functions. So BDP, I don't know what that is, but it's a Bloomberg function. And then the ticker and then the security name and blah, blah. And so it fills out the security name, right? So you can figure out none of those. Try to find some numbers here that none of these are referenced. These are all just set in. Anyway, I was going to try to show you that Bloomberg has its own function. So you can use this function builder and find out, like, if you want to create your own function, you can. Although this is taking forever to load. So what it'll do is it'll pop up with like, what kind of things do you want to find? And then you click on it. There you go. So I want to find, so generates a bond for an issuer. An issuer is a stock. So bond chain. Okay, cool. And then the next thing I want, there you go. It's just so slow right now. I just turned on the computer. Maybe that's why. So what stock do I want? So I can click on IBM, and then later when it gives me the function, I can just replace this with a different stock. And then what's the chain type I want? I want their bond, the filter. I can say, what do I want their coupon payment. I want to know what the coupon is for that bond. And then I'll just hit OK. Although I just put that into somewhere random. I don't know where to put it. Okay, so their coupon payment right here is $727 for some random bond that I didn't select. So then what I would do is I'd go back and I'd change this to some other company, right? Apple, something else. And then this is invalid parameter because I didn't select the. Oh, I was clicking at the wrong cell. I'm on this cell. Sorry. So it's invalid because I didn't actually give it a bond. So I'm gonna undo that because I don't actually want that. Oh, I can't do it. But so I'm gonna, well, that was just to show you that you can build your own functions if you wanted to. Let me close this real quick and then reopen it because now I broke the sheet by adding that. Okay. So just double clicked on it, then you can hit open, launching Excel. So this is something we can use to help try to figure out what pricing we might want for a stock. And the way that this works, I'm going to kind of go in detail a little bit. So let's say I'm going to do, I was going to use Duke, and they're an energy company. And I thought maybe an energy company will do better in a recession. I don't think so. Now that I've looked at them a little more, I'm not really a big fan now. But when I first started, I was like, I need to show you something for this. So here's like their financials, just kind of like a snapshot kind of thing. It's the summary analysis. It's just this part. And so that's just giving you like, okay, here's what the revenue might look like. And you notice, right, where are we? Here. So this is by year. So 2022, December of 22. And you can see these are A, these have A on them, and these ones have E on them. And the E is estimated, and the A is actual. So these are the actual numbers that happen, and these are the ones that we think are going to happen based on our math, right? And so we're going to figure out, okay, well, if this is what, if estimated, if these are what happened, then the stock price should be worth something else, right? This is a little bit of an upward trend. That's kind of cool. Their free cash flow is more of what we want. So on the left-hand table over here, this is based on their free cash flow. And on the right hand over here, this is based on their like income statement, basically. So their free cash flow is like how much extra profit do they get, and their EBITDA is like how much do they make before they pay for their depreciation and their interest expense and their taxes and stuff. But either way, we can figure out a price of the company either direction. Doesn't matter if we're going to do free cash flow or EBITDA, but some companies might want, or for some companies there might be a better option, like easier to value a company based on free cash flow in some industries than others. So that might make a difference. To edit this file, the orange cell, every time you see orange, that means you can change that and it will affect other stuff. So anything you see orange means like you edit it. If it's not orange, maybe don't edit it, right? Unless you really know what you're doing. So if I go click edit row here, it drops down this menu, and I can even drop down farther. And so within this menu here, like this blue box, I can do lots of changes on assumptions. So right now it's set for 6% is next year's growth model. It's actually a 6% growth because this is the estimate for December of 2022. So it's really only like a couple months from now. But they'll say, okay, well, I think year over year, we're gonna have a 6% growth on, what is this, revenue? So 6% revenue growth. What if we had a 2% revenue growth, right? Then it changes some of these numbers. Or I can click for the following year, instead of a 7% growth, what if I want a 1% growth? Then I can click on any of these boxes and it will be like, it'll select those, right? And you'll see they kind of update. And so if you get annoyed like me about those numbers automatically updating and you're like, please stop changing while I'm clicking, then instead you can go down here and put like a specific number. You say, instead of I'm estimating a 6% growth rate, let's say I'm estimating the number to be $30,000. I'll just type 300,000. $30,000. So I want it to be $30,000 estimate for the ending for the revenue for the ending of December of 2022. I think that's what it's gonna be. It's actually 30,000, but it's in like millions, so it's 30 billion, right? And then next year, I think they're gonna have a 6% growth rate, and I think they're gonna keep having a 6% growth rate from then on. Now I go up here and I say, okay, so what their stock price be under this model, because this is the EBITDA model, because it's using their income statement. So under here, I say, okay, then it's 100 estimated value per share, $149.32. If they had $30 billion in revenue and then 6% growth from then on, then they'd be worth $149. Currently, Duke, where's the DQ? Sorry. There you go. So currently Duke is at 103. So if that was the case, then we'd say, cool, they'd go from 103 to 149, and maybe that works. But we don't actually think they're going to have $30 billion in revenue at the end of the year. So let's say they have a 6% growth. At that point, they'd be worth $114 a share. Okay. So at 103 today, we think maybe they should be worth 114. That right here is an 11% gain. Like I might be able to deal with that, right? Unless there's some other better option. But there's a few other things that go along with that, right? This $114 a share is actually if the EBITDA multiple, meaning how much their value in terms of their earnings before their interest. EBITDA is how much do they make before they pay interest, taxes, depreciation, and amortization. So it's earnings before interest, taxes, depreciation, and amortization. So prior to all of those costs, how much money did they make? And then are they valued at 13, almost 14 times that number? That might be normal, but it depends on the industry what normal is there. 13.9 times EBITDA might be normal for the energy industry. It might not be normal for like tech or healthcare. And then what's the discount rate? What's their cost of capital? Now here's where I might like trend more in the higher section, right? Because I'm going to look back. I'm going to go over here. I'm going to look at Duke's. What is there? There you go, find it. I closed it. So WAC, I'm gonna go to WAC. Oh, I'm on the S&P 500. I gotta change that too. So I need Duke, US, an equity, and I want their WAC, their weighted average cost of capital. And if I go over here, I can see this is the WAC, right? So if WAC ranges between 5 and 7%, and I look over here and I see currently their cost of capital is 6%. So ranging between 5 and 7 probably makes sense, except I think this cost is going to go up a bunch, right? So I can click on this cost, 5. Sorry, I hit the escape key because I was trying to get out of that menu. Okay, so I can say, well, I think the cost of lending for Duke is going to increase, which should make their WAC increase. Currently, their WAC is at 6% because their cost of debt is at 5%. But interest rates are going to go up over the next couple of years. So let's say instead that interest rates for them, their note rate goes from 4.9 to 6 point, or it was 4.19 to 6.19. Let's say rates go up 2% there. And then their bond rate goes from 3.68 to 5.68, right? Everything goes up by 2%. And then I hit update. And now they're at a WAC of 7.3, right? So now I want to go back here and I want to say, well, that's higher than this. So that means their price should probably be less than 1.0 or $104. And I go over here and I say, okay, well, or was that? Go here. I say, well, what's Duke's price again? Oh, it's 103. So I'm like, okay, maybe they're fairly priced. So that's kind of what I was saying earlier. Is like I pulled them up because I thought, oh yeah, let's use them because I think energy companies might do pretty good. So I was like, let's pull up Duke. And then when I started looking into them, I'm like, man, they're probably fairly priced. So maybe they're not a good buy. That's going to happen a ton when you do research on this. You'll be like, okay, I'm like, this looks really good. And then the more math you do and the more like research you do, you're like, okay, yeah, maybe that's not as good. But they got all this other stuff, and you go dig into that. You're like, okay, no, it wasn't as good as I thought. And eventually, you got to just decide when to cut your losses onto another stock. That's just kind of the way it works. But in the meantime, while you're doing all that, you learn a ton about how different companies work. And then I know the normal like reaction is, I wasted all that time, but you get a good understanding of how things work. Then when you go on to the next one, you understand a lot more about it. Where did I get the what? Oh, just because I'm thinking the Fed's going to raise interest rates. The Fed doesn't get to pick what rates are on bond. So there's like a risk. What do you call that? Like add-on. That's not the right word, but like because Duke is not the U.S. government, there's some risk, right? They don't get the risk-free rate. So in order for Duke to borrow, they're going to have to borrow higher than whatever the risk-free rate is. If I go look at the expected bond, so there's actually we can go look at what do we think treasuries are going to be. So like for Duke, actually we could. So this is the other thing we might want to look at is DDIS Duke shows me like this is their distribution of their debt. And I say, okay, what is the normal distribution of their debt? Well, it goes pretty far out, but a big chunk of it's in this like 10-year range from 22 to 32, right? So I might say, well, Duke's cost of borrowing will probably trend similar to the 10-year Treasury plus the risk adjustment, right? So the Federal Reserve gets to borrow 10 years at what rate? Duke probably gets that plus some more, right? So I added 2 because I wasn't just going fast. If I was doing this for real and I was like actually going to give a pitch to everybody, I'd have more research into why did I go up 2%, because I might not really pick up 2%, but I think up 2% is kind of fair considering that the Fed is going to raise interest rates, the baseline like federal funds rate, by probably 2% or so over the next 2, 3, 4 years. So Duke is going to exist for more than 4 years, then probably their cost of borrowing will go up too. That's just the idea. But if I could change this, I can go back to Duke here, change this 7.6, and instead of going up 2%, I'll just go up 1%, 5, and then this other one go 4. So I'll just what I'm doing is I'm lowering these by 1 because I already upped them by 2. So I'm really just upping them by 1 instead, hitting update. Then we're at 6.6. So now you're like, okay, 6.6. So then I'll go here and then say, okay, maybe it's worth 109. And the thing is, like, it's getting less attractive, right? The point is, when interest rates go up, Duke gets less attractive. And I know interest rates are going to go up. There's no question that's going to happen. So Duke is looking less and less attractive the more rates go up. And rates are definitely going to go up over the next 2 years. So I'm kind of thinking, maybe not. That's the idea. If let's say this number, after I did the math, this starting kind of center number here was like 250 instead of 114. and then I raise interest rates and it goes from 250 down to 200, that's still, I'm going to say, okay, by definition, yes, it's looking less attractive, but it's still great, right? Because it's currently priced at 100. It's 100. I'm going from 120% return down to 100% return. Yeah, that's not as good, but who cares, right? Yeah. So in this case, I'm going from 11% return to maybe like a 4% return, if that. I might say, well, maybe I can do better than hoping, because right, this is my target. If I'm targeting a 4% return, I don't know. There's a couple other things you got to factor in. Is if everyone's losing 10%, actually, the market's down 20, right? The market's down 20% so far this year. So if everybody's losing 20% and I'm making 4, I'm the best investor in the world, right? And so you got to set aside some of your like historic mindset where you say market's going to return 12% every year, and you say, well, if everyone's losing, I can just break even and I win, right? So I might look at Duke and say it doesn't look so good because I'm only gonna make like 4% or something. If that 109, the stock's priced at 109 right here, and they're at 104 right now, whatever the heck that is. But the computer's super slow. Right, 109 over 104. That's perfect. 109 over 104. So that's a 4% return, just shy of a 5% return, right? Subtract 1. There you go. So just shy of a 5% return. But if everybody else is failing, a 5% return looks great, right? 5% on 25 is going to be like we make $1,200, right? Yeah. So if our entire portfolio was invested in Duke and everything I just said was 100% correct, and we end up making 4.8%, we'd make about $1,100, $1,200 on our entire portfolio. That's kind of where we'd be, right? That's maybe not what we want. I don't know. There we go. I have a hard time with mindset too, like setting aside, prior, expectations. I spent 40 minutes just rambling about Duke and interest rates, and I was supposed to ask you all. So I'm sorry. I don't really want to be taking the lead so much. I want you all to do it. So, yep. Good call. Yeah. So what tools are there to analyze an ETF? So on the keyboard, and if you all look down right now, along the top is these yellow keys. And so from going from left to right, government bonds is F2. And then right next to that is corporate bonds, and then mortgages, and then money market accounts, then municipal bonds, then preferred shares, then equity, then commodities, then indices. And indices is going to be the ETFs. And then the next ones would be currencies, and then F12 would be an overall portfolio view. And then the green ones above those are going to be things like I can quickly search for something. I can pull up the news. If I just hit the news key, it'll pull up my news file. I can go message somebody, right? Those are the other ones on there. I don't really care about any of those. Quote function will pull up whatever the last stock I looked for. It'll go find its like price and stuff. So last one I looked for was Duke. So I hit the quote function button. This is the green key on the Bloomberg keyboard. A traditional keyboard on a computer won't have that. There's these extra keys on a Bloomberg. Okay, so if I want an ETF, what's an ETF I might look at? What do you think? Oh, awesome. So like the NASDAQ or whatever? Yeah. So then what I'll do is I'll do US, QQQ US, because we're looking at the US version, and I'm going to hit the F10 key for index. And then it says the American Stock Exchange QQQ Volatility Index. Is that what you're thinking? Cool. And then it's going to say, because I didn't tell it to do anything, all I did was say, hey, here's an index. And it says, okay, what do you want to do? So here's like the baselines of everything you can do. So fund reporting, news, total return analysis, that might be something useful to do. Comparative analysis versus some other stuff. So if I want to see like what kind of things would you want to look at for the fund, like what the ownership? Yeah, like price trend. Yeah. Okay. So GP for any security or whatever you're looking at was always going to be to graph it. So since I already typed in the Invesco QQQ, then it's already like my baseline function that I'm looking under. So I don't have to type it again. I just hit GP for graph, and it'll pull up a graph. And then I can overlay. So this is the QQQ one, and I can overlay something else on top of it if I wanted to. So what do you want to lay on top of it? Okay, fine. So then I have to figure out how we do. So hold on. Quick add. Yep. So add data. So SQQQ. Yep. And then it comes. So the ultra short. So it's ProShares ultra short. So that's that. What that means is it's that fund is shorting the QQQ. So short QQQ. right? And then hit enter. And now we got two of them. So the blue line without the fill is the SQQQ, and the blue line, the white line with the blue fill. And what we can do on the right-hand side is just change that because that's terrible. Let's go red for short and blue for long, I guess. So that, for you all in the room, that's probably terrible. White. Is that easier to see? Okay. So yeah, so the white line that doesn't have the blue fill is the short. So I mean, they're designed to be opposites of each other. So like maybe this one went a little higher than this one went down here. So that's not perfectly opposite, but pretty close, right? You can kind of see how they kind of run opposite to each other. What do you want to do with that chart though? Oh. Yeah. Yeah, so it's kind of hard. So for an ETF, I might want to go like ETF ownership. HDS. Okay, so holders, HDS. So here's all the people that own QQQ, which is going to be a ton because that's probably one of the largest owned ETFs in the world. So all of these people own QQQ, and I can probably scroll. Yeah, you can see I've done like 400 wheels on my mouse already. I'm only this far down. Like there's everyone in the world owns QQQ. But if I was at some like smaller fund or something that's not as well known, then maybe it'd be less people. And that's okay. So like that's something I could look at. I might care more about like what the industry is doing. So I might want industry research. So QQQ is going to be like just abroad. It's not it's not specific to something. So what if I go look for ETF screener, and then I go try to find an ETF that fits a specific style, right? So this is an ETF screener. I can say, okay, well, I want domestic. Domestic always for us, it's going to mean within the United States. Equity meaning stocks. Let's kick off global and let's do Actually, let's get rid of domestic and just do sector equity. And so we're going to say sector equity says I want to look for an ETF that's within a certain sector. Like, okay, cool. So it gives me a bunch of different choices. Largest funds by assets, lowest by fees, highest year-to-date return. That might be one I'm doing. I want to do for some research, right? So highest year-to-date return. So energy exploration seems to be pretty good. Oil and gas exploration, natural gas, energy. So energy companies, and this is kind of why I thought maybe let's look at Duke, because I know that the energy sector has been doing great this year, right? So this is year-to-date returns. So what I did is, sorry, I clicked without saying it. I clicked show all here, and so these are the highest ones. Is there anything in here that's not energy? I don't know. But we might look and see what other sectors besides energy. It looks like a lot of these are energy, and I might want to like restrict it to some other thing. So I might say, if I can do, just advanced screening, FSRC, advanced screening. So I might say like it has to be. So this is be like I can start adding criteria. Let's say ETFs. So there's 536 possible ETFs that that fall within whatever category I already clicked. And then within here, I might say it has to be domestic or something. So I'll just type domestic. Okay. Yeah. United States territory of domicile. That's fine. Okay, so within the none, that doesn't make any sense. Oh, it just had to load. Okay, so 536. I already had. I was looking within the United States. So let's try another one. So I want energy. Clean energy, if I want that. Closed end funds. I want a closed end fund, yeah, because that's going to allow us to not have to pay a fee, right? So we want like none of them are closed end. Closed end fund, closed end investment fund. Huh? Yeah, that's weird. So I don't know. This isn't helping because I haven't really narrowed it down. I've narrowed it down from 114, no, from 1,142,000 to 500. But I'm gonna do that anyway for the sake of time. But okay, cool. Show me those ones. And then so all of those are in the United States. Energy, right? So there's all these different funds that do energy. Do I want inverse real estate? That would be kind of cool. We might go look at that in a minute. But let's go. I'm gonna click this natural gas one. I'm just picking one randomly. So FCGUS, FCGUS, and then it'd be an index. Okay, it's not an index, it's an equity because it's a closed-end ETF. If it was an open-end mutual fund like SBAIX or something, then it would be an index. So let's go look at the description. See, cool. First Trust Natural Gas Exchange Traded Fund Incorporated in the USA. Fund seeks investment returns that correspond to the ISE Reverse Natural Gas. Oh, Revere. Sorry, Revere Natural Gas Index. So okay, cool. So what are it holding? What does it own? It owns ConocoPhillips. We can't own this fund. Devon Energy, Marathon Oil, that kind of stuff. I have to figure out. So here's the thing. This is why I wanted to show you this earlier. Certain investment restrictions represent the values of social responsibility expressed by the Board of Governors. Board of Governors are our bosses, right? All of us are bossed by the Board of Governors. The assets of the endowment pool will exclude direct investments in the specific top 200 public coal, oil, and gas companies as defined through 350.org. So this is where I don't know. So it says direct investments. Can I buy an ETF that buys those other ones? I mean, I might make an argument, yes. The other argument is like the category of this title here is social responsibility. And I have in my head, I have a conflict of and this is most of my life, welcome to my life, is I can make an argument both ways. And I kind of have to say the purpose of this statement here is to show that we're like, we're taking a moral stance, right? An ethical stance. And the ethical stance is like, I don't want to support the companies that are polluting the environment in the world, right? And so I say, well, the rules say I can buy a mutual fund or an ETF that invests in those things. I don't have to have it. My hands are off. Are my hands clean? I don't know. So maybe we skip energy altogether, which sucks because energy is doing good. Find something else. Go to a different field. I don't know. I don't get to pick the investment. That's your job. I just get to advise, which is awesome for me because I get to say, wasn't me. Not really. I still, unfortunately, I'm still in trouble when this doesn't work. I don't know. What do y'all think? It is a great area. When I meet with Ahmed, the VP guy, I'll ask him what he thinks. And then the people who manage the university's portfolio offered to come talk to us whenever they're here. They're going to be here in October, so I'll ask them to come in and meet with us. It'll certainly be on a Friday. I don't know that it'll be noon on a Friday. I'll figure out what time they're available. But when they meet, it's usually a Thursday, Friday kind of thing because they have like people travel from all over to come to this event. It's not like it's fancy or anything. It's just that all of our donors and people live in elsewhere, so they usually put it near a weekend because it's easier to travel. Okay, so that's okay. We don't need to answer that question yet. I'll get them to answer it for me. Okay, back to answer your question about. Okay, so yeah, one thing that's super helpful to do is at the top there's always this related functions. So I'm under description. So what's related to description? Probably not that much, but maybe I can go find like, okay, this is performance, and so maybe I say. This is FCG performance. So perf. See what happens if I type perf. No, none of that's really good actually. So let's do FA for financial analysis. See if I can get financial analysis on the fund. It might not because it's a fund. Yeah, so that's not going to work for an ETF because financial analysis is like, what's their net income? Well, it's a mutual fund. It's not a stock. So maybe I go look at document search might be helpful, and then Bloomberg Intelligence might be helpful too. The document search shows me all of the like information I can get about them, which apparently for this company is nothing. But then I'll go Bloomberg Intelligence and see what the Bloomberg research team said. Nothing. Great. So maybe I don't pick this fund then. But I can get Bloomberg research for stocks for sure, basically any stock. Yeah, sorry, that didn't pan out as good as I wanted. For ETFs, it's a lot harder because like an ETF doesn't do business other than their business is to buy other stocks. Yeah. Okay, what other things do you all want to look at? DDIS. Yeah, so DDIS is, I forget what it stands for. It just says debt distribution. So DDIS, debt, this. And that'll work for individual companies that have debt. If a company doesn't have debt, it might just have a blank chart if there's no debt, or it might say there's nothing. Yeah. The Walmart US Equity DDIS. Is it that it's loading? Does it on the top right? Does it identify green as something? What do you have checked on the left side? Consolidate current issuer and subs. Yep. United States and all that other stuff. Then I don't know why yours would look different than mine. Where is your you have display to maturity and breakdown by coupon type at the top? Or breakdown by something else? Breakdown by 10. There you go. Okay, so amount available. So that must mean it's like a they could have lent more. So there's unsold debt, I'm guessing. Let's double click on it, see what happens. So Walmart RevGuard. I don't know what RevGuard is. I can't open that. Senior unsecured note. Get the description for it. Let's see what happens. This is, oh, there it goes. It took a while to load. Okay, so it's a general purpose loan, whatever. Additional information. So this is for their debt, right? So we'll have committee meet. Oh man, this is hard to read. Will be subject to floor of 10 basis points and 75 basis points cap. Interest rate is based on credit default swap. See credit agreement for CDS rate. Deal. Says none is outstanding. Deal size of 10 billion. So they borrowed $10 billion, revolving. So it's a revolving debt. So what that means is they can pay it off and then borrow more, kind of thing. So it's kind of like a HELOC that you might get on a house, where they say, here's the total amount that you can borrow, and then they can start filling up that amount. They just haven't filled it yet. So if I go back to DDIS on Walmart, so amount available is 10 billion, but that goes up to 16. So they had another, so these are 3 other loans. So they have, or 2, there's 3 total, 2. So one is already completed, 4.1 billion, and then another loan at 1.6 billion, and then an additional 10. So these 2 combined are worth just about 6, and then this additional 10 is available for them to pull on if they need to. And then their revolving debt. So we went over there and looked at that description. So it's between 75 and 2 basis. What do they say? 75 and 100 something basis points or something like that. That's how much they're allowed to borrow, right? And at their rate, between 10 and 75 basis points. Oh, that's a fee to get it. What's the coupon on it or whatever? I don't see. So we can figure out what their debt load is on that, but index plus margin. So they can borrow by, that's the index, TSFR1M plus 60 basis points. So Walmart gets to borrow at 0.6% more than whatever the TSFR1M is. TSFR1M is SOFR rate. So they used to have a thing called the London Interbank Offer Rate, and then they scammed everyone, so they made it SOFR rate now. I know this is too much like background for everybody, but so the SOFR rate is like the new like prime rate. So basically what that means is Walmart gets to borrow at the prime rate, that's TSFR1, so that's the 1 month prime rate plus 60 basis points. So sorry, that took me a while to like get my head wrapped around what this is. This is a recurring debt that Walmart can borrow from and then pay back off really quickly. It's like short-term borrowing. And it's priced at an interest rate of whatever the 1 month prime rate is plus 60 basis points. So Walmart gets to borrow at 60 basis points ahead of prime rate, which is decent. But the prime rate could change all the time because the Fed is raising interest rates. So the Fed will raise interest rates. Walmart will get whatever the Fed raised interest rates to plus an additional 60 basis points of what Walmart has to pay. Yeah. So that's the additional add-on for having risk, right? Walmart is not the US government, but they're damn close. That was a joke. But yeah, so they get a 60 basis point increase for having a little bit of risk as a company. Wow, that's graduate level finance there. So welcome to your MBA, I guess. Okay, what other things can we cover? It's actually 12:58, so maybe I call this good. Let's I don't have an ETA on when we can place our first trade, but I want to get started on let's really pick a stock now, right? So how about what do we do? What do we need to do to actually pick a stock for our fund? Or pick a structure to our portfolio? So do we want to baseline on the S&P? The S&P sucks. Or do we want to say, let's not have the S&P at all, given that it sucks, and have just stocks? Or do we want to go all funds? I say this is the core group right here, because no one else is on Zoom anymore. We had landed here on Zoom a bit ago, but let's just say, let's vote amongst ourselves. What do we want to do for the portfolio? And you all argue too. I'm pushing the onus on you all. What do you mean one side? Oh, fair enough. You want to have a mix of individual stocks and mutual funds or ETFs in our portfolio? Yeah, I think that's a good idea. There, I should stop. Okay. Yeah, I'm down for that. So just for purposes of, as long as they make sense. Oh, okay. Slickcharts.com, is that a reputable site? Oh, that's every individual stock. I just want it by sector. Okay, so what else do you want to do then? I was thinking, if we look at this, can people give me what I want instead of what they want? Actually, oh, that's not what I wanted. All right, this is close enough. It might not be exact, but that's close enough. So this is the SPY, which is an ETF that tracks the S&P 500, and it's like command or whatever for them is to match the S&P exactly. So this is their weightings, not necessarily guaranteed to be what the S&P itself's weightings are, but it's probably within a percent for each of those. So we might, if we're going to look at a bunch of different funds, we might say, I want to own some stocks, some funds, and the collection of them together doesn't match this, because then I would just be matching the S&P, and I don't want to match the S&P because they suck. So instead, I want to match close to this, but I want a little less in one and a little more in another, and a little less in a different one, a little more in another one, right? I just want to be kind of near this, but not quite exact, right? And so we say, okay, well, maybe we want a bunch in technology, but maybe not a full 24.5%. Maybe I say 20% technology, and then energy, instead of 4.6, I want 10, right? I'm making those numbers up. I have no idea, but let's just say, that might be something. And then we can adjust each of them a little at a time. And then later, when we report our returns, we'll talk about that, right? There's a thing called tracking error we want to look at. We'll look at, our risk return trade-off and a few other things that we'll use to measure our performance. But we'll say, here's how we changed our portfolio so that we weren't exactly the S&P, and here's how that affected our return. So far, I think we've settled on we want ETFs, mutual funds, stocks. What else are we doing?
kind of liking the inverse.
Yeah.
Yeah, and if we expect, is the Fed targeting like 2%?
Long term. So the Fed is targeting a long-term 2% inflation, but right now we're at 8.5 or 9 or whatever. So they need interest rates to be at like 4 to bring back down to 2, so that then they can lower interest rates back down to like their long-term 2, 3, whatever. Yeah. So you're thinking, so would you rather have an inverse ETF that says I want the opposite of something, or would you rather have stocks that do good in recession? So, Ricardo's like inverse, hard inverse. Everybody else says, yeah, both's good. There's stocks that do good in recessions, though, right? Alcohol, we're not actually banned from alcohol companies. We're banned from tobacco companies. And beer tends to do, I mean, we're Chico State. We'd throw a fit if we got banned from alcohol companies. Usually beer does better in recessions. Probably because people are trying to drink away the thought that they lost their job. But you know, you always, if in your business classes at some point, you must have heard that like beer and diapers sell really well together, like that kind of thing, right? It's just like trends that go that go together. So recessions and beer tend to do fine. And then we can find an inverse ETF. You all want to look at some things that might do good in a recession. So last time we met, I said, come back to this meeting. We'll know what happened with the Fed interest rate decision. And now we're 100% confident the Fed isn't wavering. They said, yep, we're going to keep raising interest rates and we're just going to continue to do it. So now we know, okay, so let's find stocks that do good in higher interest rates. So how about we come back with stocks or inverse ETFs to look at? Did anybody come with stocks and inverse ETFs to look at today? Because I did say that one. Yes. Okay. So and those are the ones that don't match the economics, right? So drug manufacturers can do good no matter what the economy is doing. They can also do bad no matter what the economy is doing. So okay, so Eli Lilly might be one that we look at. They're a drug manufacturer. What's their ticker? Oh, really? Okay.
Average 22%.
Wow.
And this is really cool.
Oh, okay. Yeah.
Are asking for
Oh yeah.
and like all ever had to give them, give up their kind of like up their energy. Nothing. There's nothing, right?
Are they currently in FDA trials? Okay, what round of FDA testing are they in? You know? Okay, I'd look into that. So do you want to come back next week? Are you going to be here next week? You want to come back and give us like a breakdown on what the drug is, where they are in testing? Fair enough. I can help you. I can do it. All right, Eli, can you just email me what the name of the drug is and I'll go look at it?
Yeah.
Okay. So let's do that. So we'll look at that next time, but that doesn't get everybody else off the hook too. So let's figure out what stocks we should be in or what inverse ETFs we want to be in, where we want our overall weighting to not be. How do we do that? How would we measure if we were in an ETF? What is our weightings? We say we're negative, whatever the weightings are. I don't know. I have to go look at that. I don't know what that, like academic finance doesn't have that like as a default choice. So I'll go figure that out. But this is Eli Lilly's. This is intraday charts. This is a 3-day chart. Looks like they did pretty good over the last 3 days. So there's usually 3 rounds of FDA testing that have to happen, right? So the first round allows them to like go into more human trials and then fully approved, and it just cures cancer. Like you just take this pill and like nobody has cancer anymore. Okay. How is that not front page news of the world? There's more to it than that. So yeah. So plus, if we look at this, they went from 300 to 310. That's only like a 3% growth. So a 3% return on curing cancer doesn't sound right either. Yeah. Okay, so that might be one we want to look at. I'm down for that. So I think what we need to do, and I think what all of us should do, is try to meet at different times other than just this. Like we can't manage a portfolio 1 hour a week, right? So we need to be meeting separately, and we need to structure like what is our portfolio going to look like, and then what are we going to put in it. So we need to do that separately too. Okay, I did email the bot team that we'll be meeting Wednesday afternoons. So if you want to be on that bot team to code the auto trader, we're going to be 4 to 5 on Wednesdays in this room. So that's available too. Okay, what else are we missing? What else do we want to do? Cool. Let's do that. Whoever's on portfolio management team, yeah, let's set up a time. Who here is on portfolio management? Okay, cool. So then let's just hang out for a bit afterwards, and we'll figure out a time where we can meet. And then everybody else wants to do equity stuff or macro. So who's here with macro? Just the one. Okay. You want to give us a little macro breakdown next week too, of like what's been going on lately? Sure. Okay. And then everyone else is equity then? Okay. So come back with some equities. We'll say, or whatever. Equity is my generic term, but it could be ETF or something. But come back with something next time and say, here's what we're looking at. We don't have to make a decision on buy or sell. We just need to start, digging. Because I mean, we're getting to the point where, we have the money sitting there. So we should do something with it. It is an option to say cash. Cash is inverse market, right? So you say, well, instead of having inverse ETF, I just have cash. Market crashes and I win, right? That's a choice. So, okay, I'm gonna hit stop recording on the Zoom. I realize it's gonna be super long, but I'll post it today.